Imagine a room filled with Goldman Sachs leadership team plotting a revolution. The target, consumer banking. The weapon, digital technology. The year is 2014 and the stakes are sky high. However, this isn't a story of triumph. It's a cautionary tale, a tale of ambition, miscalculation, and a multi-billion-pound lesson in misdirected digital transformation. Prepare to have your assumptions challenged. Welcome back to part 2 of our Goldman Sachs case study. For those who joined us for part 1, you'll recall we discussed a common paradox. Businesses, even the largest, often chase digital initiatives due to market pressures, not strategic fit. Today, we're moving forward with the Goldman Sachs narrative, focusing on the bold, yet ultimately revised, attempt at entering consumer banking with Marcus. Picture the scene in 2014. Goldman's top brass are gathered away from Wall Street, and they make a pivotal decision to leverage their banking license and create a digital-first consumer bank. This was a major departure from their traditional institutional and high-net-worth client focus, driven by a desire to diversify revenue streams and demonstrate the bank's digital evolution. However, reality didn't quite match the initial vision. In this episode, we'll examine what might have transpired if Goldman's decision makers had adopted a different lens, a stakeholder-first approach, underpinned by a framework we call swifter. What if they'd prioritize internal culture, operational readiness, and long-term feasibility alongside those market trends? While Marcus isn't a complete failure, its initial ambitions were significantly curtailed. Our aim here isn't to criticize, but to learn. Digital transformation demands more than just ambition. It requires genuine alignment across your entire business ecosystem. It's about a 360-degree view, not a blinkered focus on one area or one stakeholder group. So let's delve into what could have been had Goldman gone down a path using our framework, and how your organization can avoid similar pitfalls. Let's recap the concept of the paradox of choice. As we discussed in part 1, when it comes to digital transformation, business leaders from SMEs to FTSE 100 giants face an overwhelming array of options. The sheer volume of choice can lead to inertia, with decision-making grinding to a halt. In the absence of a robust decision-making framework, leaders often rely on a few common crutches. Seeking advice from internal or external consultants. Mirroring the actions of competitors. Being swayed by the fear of missing out on the latest tech buzzwords like blockchain or AI. Consequently, decisions are often driven by a combination of these factors. Once a course is set, the focus shifts purely to execution, driving the team to achieve the objectives as effectively as possible. There's a reluctance to pause and critically assess fundamental questions such as, are we truly addressing the right business problems with these digital solutions? Is this the optimal strategic path, or are there better alternatives? Is our current strategy likely to yield the highest possible impact? Now, I'm certainly not suggesting that all digital transformations are doomed to fail. Many organizations are achieving truly transformative results. However, with failure rates estimated to be around 70%, it's clear that something isn't working as it should. In this episode, we'll explore what I believe is a key underlying cause, embarking on the wrong strategic path in the first place. Because once you're on that ill-fated path, no amount of hard work, investment, or technological prowess can deliver the desired outcome. In subsequent episodes, we can explore the reason why digital transformations fail, even when the overall strategy is sound. But in this case, execution is weak. So more to come as far as that's concerned. The lesson I want to highlight with this case study is to ensure you are on the right path in the first place before tightening the screws on your digital strategy implementation efforts. So let's return to the Goldman Sachs case study and dissect the core reasons behind the scaling back of the initial ambition for Marcus. In 2014, Goldman's leadership team convened at an offsite. I believe it was a holiday home belonging to the firm's then president. The discussions were inevitably shaped by the aftermath of the 2008 financial crisis. The regulatory landscape was tightening, and increased scrutiny of investment banking activities was a given. While Goldman Sachs' core businesses, investment banking, transaction banking, and wealth management, remained strong, their revenues were inherently cyclical, subject to market volatility. At the same time, financial services sector is experiencing the exciting rise of innovative fintech lenders who are bringing fresh, alternative lending and saving solutions that prioritize a better customer experience, along with lower costs. Key players include emerging startups like Lending Club and social finance, alongside the rise of neobanks. These are digital-only banks such as Chime and Simple. Goldman's traditional rivals such as JP Morgan and Bank of America were also making significant strides with their own digital consumer banking strategies. After the crisis, Goldman's transitioned into a bank holding company to secure emergency funding. This change granted them a banking license, which some might say wasn't being utilized to its fullest potential. Against this backdrop, Goldman's leaders during the retreat made the decision to launch a consumer bank, a completely new departure from the firm in its near 150-year history. Following extensive customer research, Marcus officially launched in 2016, structured not as a separate subsidiary, but as an integral division within the firm. A new division, the Consumer and Commercial Banking Division, was established, operating alongside Goldman's other three core divisions: asset management, global markets, and investment banking. This gave consumer banking a seat at the top table. Harit Talwar, a seasoned consumer banker, was brought in to lead Marcus, positioning it as a dynamic startup operating within a 150-year-old institution. To paraphrase Talwar himself, he described Marcus as a startup with a 150-year DNA. From an external perspective, this appeared to be a bold and potentially transformative move by Goldman Sachs, leveraging its digital capabilities, strong balance sheet, and the intellectual capital of its workforce to disrupt consumer banking. Now let's revisit that 2014 leadership retreat. Let's explore an alternative scenario. What if Goldman Sachs had used a comprehensive strategic framework, the one I'm about to outline, before committing to the Marcus venture? Would they have proceeded with the launch, or would this framework have illuminated potential pitfalls, perhaps saving them from the challenges they encountered further down the line? ultimately leading to the scaling back of Marcus's ambitions. The framework we use prioritizes a stakeholder-first approach. It's predicated on the understanding that no business, and indeed no business unit, operates in isolation. Instead, they exist within a complex ecosystem, characterized by symbiotic relationships between various core stakeholder groups. Much similar to a biological ecosystem, the health of a business ecosystem relies on the active engagement and well-being of its parts. If any one group is absent or dysfunctional, it can threaten the entire system. To illustrate, a business cannot exist without customers. Similarly, businesses are subject to regulatory oversight, and non-compliance can lead to severe consequences. Funding from investors is crucial for growth and scaling. Goldman Sachs, like any large organization, interacts with a multitude of stakeholders. To provide clarity, and more importantly, to understand the intricate relationships between them, we categorize these stakeholders into three primary groups, as I discussed in episode 1. Firstly, we have the stakeholders who we serve. These are the individuals and entities the organization exists to serve. The most obvious example is your customer base. However, this category also encompasses shareholders, owners, and investors who provide the capital that fuels the business. Expanding our perspective, we recognize that businesses also have a role to play in serving the broader community in which they operate. This entails a social responsibility to the community and a commitment to environmental stewardship. Therefore, society and the environment are also key stakeholders within the who we serve category. Secondly, we have the enablers. These are the stakeholders that empower the organization to effectively serve the who we serve group, our customers, shareholders, community, and the environment. The primary example of enablers are staff, management, and suppliers. We'll delve into the specific enablers group relevant to Marcus by Goldman Sachs shortly. For now, I want to provide a general overview of the stakeholder mapping model. Finally, we have the influencers. These stakeholders shape and guide how the organization serves the who we serve group. This includes the board of directors and senior executives who set the strategic direction for serving customers, shareholders, and external stakeholders. It also encompasses regulators, industry associations, standard-setting bodies, and industry analysts who significantly influence market perception and share price. It's crucial to emphasize that these stakeholder groups don't operate in silos. The actions and decisions of each group have ripple effects throughout the entire ecosystem. For instance, customers demand a superior digital experience. It's necessary that enablers, such as staff, are equipped with the skills and resources to develop and deliver those digital solutions, and to provide effective customer support across digital channels. Similarly, regulatory bodies dictate the parameters within which organizations must operate to serve the best interests of their customers and public shareholders. This in turn requires enablers such as staff to undergo appropriate training and make it necessary for that compliance department to develop comprehensive procedures to ensure regulatory compliance. I trust you get the picture. It's a complex web of interdependencies, and hopefully you get what I'm trying to say. So let's apply this framework to Goldman Sachs' decision to launch Marcus. It's fair to say that Goldman's demonstrated a strong understanding of the who we serve category, particularly in relation to their shareholders and customers. Before launching Marcus, Goldman's conducted extensive research to understand the needs, pain points, and frustrations of retail banking customers. Hari Talwar, Marcus's first CEO, identified three key pain points as he articulated in a CB Insights interview. Firstly, he observed that people's relationship with money is broken. In his words, people are overwhelmed. There are too many accounts between cards and checking accounts and savings accounts and insurance and protection and all kinds of things. People are not in control. They don't like budgeting because they have a fear of budgeting. Secondly, he highlighted that for those who need to borrow, the borrowing process is cumbersome. It is opaque, it is expensive, and it humiliates the customers through the process. It is so insidious that if you apply for a credit card, even if you get declined, and more than 50% of the people get declined, your credit history gets impacted negatively. Thirdly, he noted that those who do save, they feel disrespected by the financial services industry. Because if you accumulate, say, $50,000, when I put my money in a brick and mortar bank and I only get 10 basis points of 0.1% rate on my hard-earned savings. Talwar emphasized Marcus's intense focus on customer centricity, stating, "At the heart, I think it's a story about growth and absolute intense, passionate customer centricity." Goldman Sachs also recognized the expectations of the shareholders, who were seeking more stable and diversified revenue streams following the volatility of the 2008 financial crisis. Remember, shareholders are also an important group in the who we serve category. Goldman Sachs acknowledged the role in enhancing the financial well-being of the wider community by aiming to address the identified pain points in the retail banking sector and improve the overall customer experience. They recognize their role in serving the wider community, also a key stakeholder in the who we serve category. Turning to the influencers group, Goldman Sachs executives clearly set the strategic direction of Marcus, and therefore were the key stakeholders in the influencer group. As Omar Ismail, a subsequent CEO of Marcus, stated in a Lendit FinTech 2018 interview, the directive from our senior leadership was build it right, go slow, do this right. And that's the directive that we've been following. Regulators are also core stakeholders in the influencer stakeholder group. Were their perspectives considered in the decision to launch the digital-first consumer bank? It's noteworthy that the interviews we have available of the CEOs don't delve into specific regulatory requirements, challenges, or concerns. Of course, whilst this doesn't mean that it wasn't considered, it suggests that they weren't a primary driver in decision-making. Of course, we don't know what went on behind the scenes and can only rely on publicly available information. Nevertheless, it's important to acknowledge that Goldman Sachs, given its background as a major player in the highly regulated world of investment banking, has a strong emphasis on risk management. Unlike the topic of compliance, the CEO interview highlights how Goldman Sachs prides itself on risk management. In Hari Talwar's words, "Unlike fintech startups, we are a bank, and we are proud to be a bank because we've got the balance sheet and the DNA of risk management and the ability to build platforms which scale up." Omar Ismail did emphasize the importance of compliance. In his words, "We won't take any risks with legal and compliance and regulatory matters." From his statement, We can interpret this as compliance is a given, but something not focused on and thought through when setting up markers. It's part of the process and a very important component. However, reading between the lines, one that would have swayed the decision to launch markers. It's plausible to assume that Goldman Sachs, drawing on its experience as a regulated entity in the financial services sector, assumed that its existing compliance capabilities would be sufficient to handle the demands of consumer banking. Again, we don't know what went on behind the scene and can only go by what was in the public domain. Now, competitors are also a key stakeholder group within the influencer group. Competitors influence the strategic and operational direction of any business. They are either emulated or strategies adopted to gain a competitive advantage against the competition based on what these competitors were doing. The key question is, was Marcus conceived as a direct response to competitive pressures? The answer is nuanced. Marcus acknowledged that disruptive fintech competitors were emerging and taking hold in the financial services sector. However, I don't think Marcus saw them as a competitive threat. Omar Ismail's view is that fintech competitors strengthen the category. In other words, the more fintech disruptors that enter the market, the greater the acceptance of fintech solutions as a viable alternative to traditional banking services. By recognizing competition from established players like JP Morgan, Goldman Sachs fundamentally believed that the existing model of serving consumers was broken. As such, Goldman Sachs' ambition wasn't merely to compete with existing players, but to become the dominant force in consumer banking. To become, in effect, the competition to the competitors. This ambition is vividly illustrated in a statement by Harit Talwar at the 2019 Brainstorm Finance Conference, when he said, "Our purpose is to disrupt the distribution and consumption of financial services. Pretty much what Amazon had done and is doing to retail, or what Apple did to the music industry." This analogy directly compares Marcus's aspirations to the transformative impact of industry giants like Amazon and Apple. In essence, Marcus's goal was to disrupt the consumer banking sector, not just by competing, but by establishing a new paradigm. This was arguably a bold and ambitious vision, particularly for an institution with the pedigree and resources of Goldman Sachs. Given Goldman Sachs' track record of success, this ambition might have seemed plausible. They have a reputation for achieving what they set out to do. Goldman Sachs conducted extensive research into consumer needs, gaining a deep understanding of the frustrations and pain points within the retail banking sector. They invested heavily in customer research, with executives reportedly spending significant time reviewing customer interviews and journey maps. They also established clear financial targets, aiming for profitability by 2024. Furthermore, their strategy included rapid expansion through strategic acquisitions such as Clarity Money and Honest Dollar. Acquisitions accelerates regulatory licensing and client acquisition. However, when it came to technology, Marcus decided to build this in-house. Goldman Sachs prides itself on its innovation and digital capabilities. Remember, they had the ambition to disrupt the retail banking industry with a superior customer experience, product, and service to become a category-defining consumer bank. Maybe this may have led them to believe that existing solutions available in the market were inadequate. Returning to the influencers group, it's worth noting that Goldman Sachs may have underestimated the influence of capital markets and investment analysts who seemed confused about Goldman's entry into consumer banking. This may seem far removed from Goldman's core strengths in investment banking and wealth management. This is where Goldman Sachs had a world-leading reputation, not consumer banking. It just didn't make sense to them. Never in the near 150-year history of Goldman Sachs did they ever diversify so far away from their core business. I highlighted in episode 3 that once Goldman Sachs announced that they were scaling back their ambition in consumer banking with a renewed focus on their core business, the market responded positively and the share price increased considerably in a short space of time. Let's now turn to the enabler stakeholder group. In my view, this is where the most significant challenges arose in the case study of Marcus. Let's explore. In our strategic framework, which as I mentioned we call Swifter, a crucial component is an assessment of the organization's will at all levels to undertake the proposed digital transformation. In other words, the willingness of the wider organization to go down this consumer banking path. Even when senior leadership champions a digital transformation strategy, it doesn't necessarily translate to universal buy-in and alignment throughout the organization. Employees may not be equally enthusiastic or prepared to dedicate the necessary effort to achieving the leadership's vision. It's no surprise that cultural resistance is pointed out often as one of the root causes of digital transformation failures. Another key element of our Swifter framework is an evaluation of feasibility. In other words, the practical viability of successfully executing the digital transformation strategy. Even if there is an organizational will to go down this digital transformation path, and there is little internal resistance, the strategic move may still not be feasible. Goldman has incredible intellectual capital and resources. However, we may find that the chosen strategy could still face some challenges and could be less feasible when put through rigorous testing and scrutiny. Other parts of our Swifter framework also encompasses innovation, implementation methodology, review of effectiveness, and course correction when needed. These are important components of the framework. However, I won't delve into them in detail in this episode because I believe that Goldman Sachs generally got all of these things pretty much right. They launched innovative products and services, developed innovative technological solutions. The execution capabilities was impressive, quickly setting up the business, making strategic acquisitions, and rapidly acquiring customers. They managed to build the technology within a relatively short space of time. And indeed, they carried out reviews of Marcus and clearly revised the strategy. The crux of the issue to focus on is the enabler stakeholder group, specifically the potential lack of the will to wholeheartedly embrace consumer banking and the inherent feasibility challenges of pursuing such a strategy within an investment banking context. Our framework clearly highlights that the primary reason for Marcus's unfulfilled ambition can be attributed to three things. Number one, an incomplete consideration of all stakeholder groups within the ecosystem, particularly the enablers. Number two, an insufficient assessment of the organization's will to commit to the chosen path. And number three, an inadequate evaluation of the feasibility of the strategy, given Goldman Sachs' existing capabilities and culture. These are the three core reasons why Marcus didn't achieve its ambition to disrupt and redefine consumer banking. By using our Swifter framework, we have a repeatable framework to assess digital transformation failures, or a roadmap to ensure it doesn't go down the path where 70% fail. Let's return to that 2014 leadership retreat and explore how a more comprehensive application of a stakeholder-first approach might have led Goldman Sachs down a different and potentially more successful path. This framework may have convinced the leadership team to remain laser-focused on their core strengths and diversify revenue streams and grow the business within this core. So let's use the framework to analyze what went wrong, with a particular focus on the enablers stakeholder group. As previously discussed, Goldman Sachs demonstrated a strong focus on the who we serve stakeholder group, investing significant effort in understanding customer needs and aiming to exceed their expectations. They also prioritize the needs of shareholders, recognizing the desire for growth and diversification of revenue streams. Furthermore, Goldman Sachs paid attention to the influencers identifying opportunities to differentiate themselves from competitors who were perceived to be inadequately serving consumer needs. However, based purely on available public information, it would seem that Goldman Sachs may have taken for granted the willingness and ability of their enablers to execute this ambitious vision, perhaps assuming that the reputation for attracting top talent, the execution capabilities, and resources would guarantee success. Staff at all levels involved in both establishing Marcus and operationalizing it post-launch were the core enablers to consider. These enablers encompass a wide range of teams within Marcus and across the wider Goldman Sachs organization. Goldman Sachs established a dedicated unit for Marcus, physically separated from the main trading floor in their New York offices, however, still within the same building. Acknowledging the specialized skills required for consumer banking, Goldman Sachs recruited experienced professionals, including Harit Talwar, who had proven track record in this sector. They also hired personnel from competing retail banks, fintech startups, and even e-commerce giants like Amazon. The Marcus team adopted a more casual dress code, trading traditional suits for jeans and t-shirts. The only thing that wasn't allowed were flip-flops. In essence, Marcus cultivated a startup-like culture. It's crucial to remember that Marcus remained a separate and key division within the parent company and was later integrated, or you could say demoted, into the asset and wealth management division. Finally, it ended up in the platform solutions business. The key question is, does investment banking and retail banking go well together in the same business and in the same building? In my professional experience spanning over 27 years in financial services, I've rarely encountered a more pronounced cultural divide than the one that exists between investment banking and retail banking. It's like mixing oil with water. Investment banking and businesses serving ultra-high net worth individuals or corporate clients are often perceived as more prestigious, high-powered. They deal with high-stakes transactions that bring significant financial reward for the businesses and star employees. These sectors tend to attract individuals with a more aggressive, deal-oriented, financially driven mindset. Contrast this with retail banking. It's typically viewed as more client service oriented business model with a focus on building long-term relationships and managing a high volume of transactions, not defined by high-stakes transactions, rather millions of small transactions making up a large diversified revenue stream. My experience is not uncommon for an investment banker to hold a somewhat dismissive view of their retail banking counterparts, perceiving them as less dynamic or ambitious. While I'm not suggesting that crossovers never occur, it's relatively rare to see investment bankers voluntarily transitioning into retail banking roles, unless it's for a specific project or due to limited alternative opportunities. Therefore, it's not plausible to infer that the will to wholeheartedly embrace the consumer banking strategy may have been limited within certain segments of Goldman Sachs, particularly outside the senior leadership team who championed the initiative. Many star performers within Goldman Sachs' core businesses may have preferred to see continued expansion within investment banking or wealth management areas, more closely aligned with their expertise and career aspirations. As markets began to report losses, this potential disdain for consumer banking may have been exacerbated, particularly within the business unit that ultimately absorbed Marcus, as these losses negatively impacted their overall performance. It's important to reiterate that Marcus operated as a division within Goldman Sachs rather than as a fully independent subsidiary. Marcus had to share resources with other divisions, including compliance teams, technology and engineering, HR and talent acquisition teams, data scientists, and product teams, among many, many others. Consider the challenges of integrating a consumer banking operation with compliance teams whose expertise lies primarily in navigating complex regulatory landscape of investment banking and wealth management, especially in the wake of increased scrutiny following the financial crisis. These teams were now tasked with acquiring the knowledge and developing the processes necessary to handle the distinct regulatory requirements of consumer banking, including managing a high volume of individual consumer complaints. It's not surprising that Marcus faced regulatory scrutiny and was found to have deficiencies in its handling of customer complaints and transaction disputes. Investigations by the Consumer Financial Protection Bureau revealed several shortcomings, including the following. Number one, mishandling of transaction disputes. Goldman Sachs failed to promptly address and resolve disputed transactions, causing prolonged delays for cardholders seeking refunds. Number two, inadequate notification of dispute outcomes. Goldman Sachs did not provide consumers with timely and adequate notifications of the outcomes of their disputes, violating federal requirements for transparency in credit card operations. Number three, inaccurate credit reporting. Some consumers experience inaccuracies in their credit reports due to Goldman Sachs's lapses in handling disputes and reporting information to credit bureaus. Number four, misleading interest-free payment promotions. Consumers were misled about interest-free payment promotions, leading to unexpected interest charges. These regulatory failings resulted in Goldman Sachs being ordered to pay at least $19.8 million in customer refunds and facing a $45 million fine. Apple, their credit card partner, was also fined $25 million for its role of potential inaction in the mismanagement of the Apple Card program. The nature of these deficiencies suggests a potential strain on customer services and compliance staff, possibly due to inadequate training and resources to cope with sudden influx of complaints generated by Marcus's successful marketing and sales efforts in attracting depositors and borrowers. In essence, the back office and compliance infrastructure may have been overwhelmed by the demands of a high-volume consumer banking operation. Returning to the core theme of digital transformation and the importance of a stakeholder-first approach, Goldman Sachs's leadership, in my view, should have more thoroughly considered the downstream impact of launching a consumer bank on the enablers and influencers within their stakeholder groups and ecosystem. Perhaps they assumed that Goldman Sachs's reputation for employing highly intelligent and dedicated individuals would ensure that any operational challenges would be effectively addressed. However, Goldman Sachs' core competency lay in serving a relatively small number of large corporate clients and ultra-high net worth individuals. This is a fundamentally different proposition to serving millions of individual customers. The decision to establish a consumer bank within an investment bank framework may have been inherently infeasible from an operational perspective, regardless of the talent and resources available. So let's go back to 2014 leadership retreat and consider how a more robust strategic framework, incorporating a thorough stakeholder analysis and a rigorous assessment of will and feasibility, might have influenced Goldman Sachs's decision-making. If Goldman Sachs had fully considered the cultural implications for their enablers and the operational complexities, they might have arrived at a different strategic conclusion. Even if consumer banking remained the preferred strategic direction, a more thorough analysis of impact on enablers and influencers might have prompted Goldman Sachs to structure the consumer banking business as a completely separate subsidiary within its own dedicated front, middle, and back office functions, as well as a distinct risk and compliance, finance, and HR departments. Marcus could have been physically separated from Goldman Sachs's main offices, housed in a different building altogether. Instead of attempting to build a consumer bank from the ground up, Goldman Sachs could have leveraged a banking-as-a-service model to gain immediate access to established banking technology and outsource back-end processes, significantly reducing complexity, development time, and costs. Given that consumer banking is not part of Goldman Sachs's core DNA, a holistic framework of this strategy might have persuaded them to focus on diversifying revenue streams within their existing area of expertise. So let's explore some alternative strategic pathways that Goldman Sachs could have pursued, leveraging their strengths and building upon their existing capabilities. Instead of targeting the mass consumer market, they could have focused on the mass affluent segment, individuals with household investable assets ranging from approximately $250,000 to $1 million. This segment is often underserved by traditional private banks. Yet their financial needs are too complex for automated robo-advisors and fintech newcomers. Goldman Sachs could have provided a digital platform offering access to curated investment portfolios, financial planning tools, and human advisors for a fee. In effect, a Goldman Sachs light service tailored to the needs of this ambitious middle ground. Such a strategy would not have required a full-scale retail banking infrastructure and consumer lending capabilities. Alternatively, Goldman Sachs could have expanded their digital services for small and medium-sized enterprises and commercial banking rather than venturing into consumer banking. The SME segment is often underserved by large banks, particularly in the aftermath of the financial crisis. Goldman Sachs could have provided lending, treasury services, and digital advisory tools to SMEs, who often lack access to sophisticated banking services available to large corporations. This could have been a high-margin business for Goldman Sachs, provided they could effectively deliver these products and services through digital channels. The strategic framework I've been alluding to throughout this episode is a proprietary methodology developed by my firm, which we call Swifter. Swifter provides a structured, step-by-step approach to implementing the right digital transformations, ensuring alignment with stakeholder needs and organizational capabilities. Today, we've focused on three key components of the Swifter framework: the stakeholder perspective, the assessment of will, and the evaluation of feasibility. If you'd like to explore how Swifter can help your organization navigate the complexities of digital transformation and avoid the pitfalls we've discussed, please do get in touch. I'll include my contact details in the show notes. This concludes our two-part series examining the Goldman Sachs Marcus case study. To reiterate, organizations embarking on digital transformations face a plethora of choices. In the absence of a robust and repeatable strategic framework, decision-making is often influenced by external factors, such as the advice of consultants, the actions of competitors, or the fear of missing out on the latest technological trends. Once a strategic path is chosen, there's a tendency to persevere, to work harder, faster, and smarter, rather than pausing to critically evaluate whether that path is indeed the optimal one. Pursuing the wrong digital strategy can be incredibly costly. In Goldman Sachs' case, the Marcus venture is estimated to have resulted in direct costs of between $3 and $5 billion, not to mention the significant opportunity costs and the strain on the organization. While a financial institution of Goldman Sachs' size can absorb such a financial misstep and demonstrate resilience, smaller organizations may not be so fortunate. For them, a similar strategic error could have devastating consequences, potentially leading to insolvency. Therefore, if your organization's digital strategy is showing signs of heading in an unintended direction or failing to deliver the expected outcomes, please do reach out to me. We offer a bespoke rescue and alignment program designed to get your digital transformation back on track. Through in-depth research and data-driven stakeholder analysis, we'll help you validate your current strategic direction, suggest necessary adjustments to bring your program back into alignment, or, if necessary, provide an honest assessment that the current path is unsustainable. So please do get in touch if you'd like to discuss how we can support your digital transformation journey, regardless of how large or small your organization is. In our next episode, we'll be featuring our first guest interview with a fascinating perspective on building digital solutions. I'm sure you will find his personal story just as interesting. So please do join us for that. Until next time, this is your host, Jay Tickham, signing off.